Hi everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Rosser, Victory Fiduciary, and coming in right now, hot off the presses with Federal Reserve's minutes and review from their meeting today. Obviously the big talk, the big concern on everyone's mind has been this inflation that's really been running rampant since February, but certainly has been affecting our economy significantly more recently. And so the Federal Reserve did just come out moments ago to say that they are going to be raising interest rates again to 75 basis points, 0.75%. And so markets were really looking for some guidance here. So we knew that the 50-point basis raise was kind of already known to be happening. And so I think markets were really hoping to kind of see some guidance from the Federal Reserve that they have a plan to kind of quell this inflation that we have right now, which is really wreaking havoc across the board. And so I think that this 75 basis point raise, while it's going to be painful in some other areas that we will discuss momentarily, from the market standpoint, I think investors are going to say, well, hey, at least we have a plan here for kind of what we're seeing to try to quell what's happening. And so markets immediately began to take off as soon as the announcement was still being made. And so I think, as I said, investors were just really looking to see some guidance from Jerome Powell and the Federal Reserve saying, hey, we're going to do something. We're not just going to let this continue to run hot. Obviously, inflation is affecting every area of our economy. Fuel prices really remain significantly elevated year over year, even from 3 months ago to now. And so that really has analysts concerned about what this could possibly mean, even looking at travel in the summer. There's lots of areas of this country that are really dependent upon tourism. And so what is it going to mean? So we see this inflation just going to the grocery stores costing us so much. So when you talk about the average family needing to fuel up at the pump, paying significantly more than what they were paying last month, they were probably paying higher prices at wherever they're going to vacation. Food prices, everything is higher. And so I know that there's a lot of kind of concern on what this is going to mean just kind of directly for our economy, even this summer. And so something else really fascinating to watch is how mortgage rates have just absolutely jumped. And when I say jump, I mean overnight. We're seeing significant jumps from one day to the next. Average mortgage rate right now, before this new increase, has been 6.5% is what you're looking at for a typical credit score 30-year mortgage. Far cry from where we were last summer when people were still getting mortgages in the low threes pretty easily. And so one thing though that I do kind of want to make with that is that those low interest rate mortgages, they were really never meant to be a permanent fixture within the economy. They were kind of a band-aid to kind of help spur activity, which we have our activity now. And so now we have this inflation that's been running hot, kind of wreaking havoc, really wreaking havoc on markets, which we'll talk about in a moment. But again, so as we see mortgage rates they seem shockingly high, they feel high, but really not that far off where we were 2 years ago, but certainly from what we've kind of gotten accustomed to, these mortgage rates are super high. And so let's go ahead. I just want to show kind of where we are year to date as of right now in the broad-based markets. And so if you can look here, so the NASDAQ down nearly 30% from our market highs today. And you can kind of just see for all three markets, it's been kind of just a downward trend. S&P 500 did officially hit bear market territory this week. Bear market really just means that we have hit 20% correction from the previous market high. And then the Dow down nearly 16%. Just kind of show where we are right now. And so here we have a technical chart of the S&P 500. Now you can see it's really been a pretty abysmal week or two within all three indexes. This is the S&P 500. And so again, what happened on Friday, inflation numbers just came out way hotter than even expected. And so we saw this sell-off that kind of began Friday, carried into Monday, carried into even yesterday some. And so again, these numbers that we're seeing from inflation, markets realize just the impact they're going to have kind of across the board. And so they're really affecting asset prices right now within the market. And what we've also found is we have had multiple periods of short-term rallies that we just can't seem to hold on to. Again, so a sign that we probably haven't found our market bottom yet. Anytime, rallies lead us to continue, market declines of lower markets going lower, again, it means that there could be a little more room for markets to continue to have some price squeeze on them. What we realized today, certainly, is looking back, we've basically given up all the gains that we've made in the market since March of 21. And so I'll kind of show you just like where we see that. This is just going back 3 years, but you can see we really now are back to where we were this time last March. Looks like my date's actually cut off there, but I checked that before we came in. So again, this is all just been since January, and so there's just been a lot of volatility. Again, a lot of attempts to kind of come back up, and then we failed every time we've hit resistance and come back down. And, if you have been following us for a while, last year, the tone of a lot of our discussions was like, hey, this is great. Markets seem to be shrugging this off, but they're not going to shrug this off forever. We're going to see, there's going to be implications for all that stimulus that was dumped into the economy. All that money that was printed was going to lead to inflation. We talked about, we knew that it was going to be happening, just kind of when, and then we would just had this perfect storm of financial risk weakness combined with geopolitical risk, and so then inflation kind of decided to show up in the midst of that. And so here we are again. When we look at declines in market, still really looks like the typical correction patterns that we see. We say a lot, we remind ourselves, markets cannot just go straight up. So as we look at the things that are going on, it still kind of seems to be an orderly sell-off, what we're seeing. And so we really just need to wait to see where things are going to kind of bottom here. Again, today, hopefully the Federal Reserve giving us, again, a little more guidance that inflation is absolutely on the radar. Again, as we raise interest rates, it is going to mean that the cost to borrow money is going to be more expensive. Mortgage rates are going to go up. Your credit card rates and credit may begin to tighten some, and so these are, obviously there's impacts there, but the bigger thing is that we have to find a way to kind of quell this significant rise in price the way that we are. And where we sit right now is we are actually now 3 standard deviations away from our 50-day moving average. As a reminder, moving averages, they act like magnets, so they always want to draw us back to that mean. Now, for a long time, we were talking about the fact that we were trading 3 standard deviations ahead of our moving averages, and so now we're saying that now we're below them. The same way, you can only snap a rubber band so hard before eventually it will snap back to kind of its intended purpose, and that is what we're kind of waiting for here. 3 standard deviations is significantly, that is a really sold off number to be at right now. And so, and again, you can see our RSI is completely washed out. Now we're like at the 30s for RSI, and we, typically around 50 is what we would consider to be neutral. So would not be surprising to continue to see some reflexive rallies going on now. Right now, today, NASDAQ was up over 2% at the time of me taping this today, and so I expect that, barring any other crazy news, that markets will probably hold on to those gains for today. Previously, a lot of the issues that we've been having is that markets have been opening up and then not being able to hold on to those gains, selling off by the end of the day, but today it seems as though we're going to hold on to those. Wouldn't be surprised if our target point winds up being about 4,000 or so on the S&P 500 based upon technicals. That is probably going to be our next level of resistance that we'd have to try to get through after that rally. So 4,000 would be right about around there. So people keep asking what's going to happen in order for us to, for this to be done, for the bottom to be priced in, for us to kind of get out of this. And so one of the ways that we'll know that it's coming is that markets will stop going down on bad news and will also go up on good news. Because right now it seems like there hasn't been much to allow the market to go up, which actually may be a good sign that we're beginning to price in a bottom. Because when investors become extremely bearish or extremely negative, that's actually usually the time that you want to consider getting back in. It's called a contrarian signal that we look at. And so last summer, if you remember, I showed this chart a couple of times. I mean, we were off the chart greedy. And so Charlie Munger used to say that you want to be fearful when others are greedy and greedy when others are fearful. So we're seeing this fear index now kind of begin to shift down back towards, if you can move me over, thanks. When we start to shift back over to extreme fear, again, that is a sign that markets are probably oversold. And so it's actually, like I said, a contrarian signal that maybe we're kind of moving in the right direction. So, I mean, you can see how spiked up we were, and now just since the beginning of the year, coming in the last couple months, we've really kind of fallen on that, and so this may be good. A lot of the things that you hear that right now, if you poll investors, a lot of them think that prices can only go lower. There's no reason at this point for stock prices to go higher. This is what people are saying, again, can be an actual bullish signal that investors are overwhelmingly negative right now, and so we'll kind of have to see exactly when that plays out. But I think that it is important as an investor to kind of keep the mindset that, you know, speculative investing is a kind of a whole different ballgame, and so we certainly saw that the past 2 weeks or so within cryptocurrencies, particularly Bitcoin. So we've seen Bitcoin has lost, I mean, billions of dollars over the past couple of days just in the sell-off that it's been experiencing, as well as all crypto has been under significant pressure, as well as the meme coin stocks, as we call them. And so again, that would be speculative. But if you're investing in quality companies that have good fundamentals, they're earning, so they have earnings to report on, they're quality companies, good fundamentals, positive earnings, that right now are just undervalued in the stock market, that's not, you know, necessarily a reason that an investor might want to get rid of those areas. Sometimes we just need to kind of hold on to them and say, you know, sometimes the market gets it wrong. Right now, maybe we're underpriced in a lot of areas. These can actually be areas of opportunity. And so as a firm, we use a lot of these times to even try to deploy a little bit of cash if maybe we have on the sidelines for clients that saying, hey, these are good companies that we know over the long run will likely do very well. Right now, just as I showed you earlier, really all areas of the market have been under pressure year to date. So the idea is finding the pockets around there and saying, okay, so outside of what we see right now today, because it's kind of things have been decimated across the board, where do we see our opportunities for the future? And we want, again, as a firm, we want to be in those companies that show opportunity. We don't like to be very, like I said, speculative, and we don't like when we're trading, we are not looking at those hot meme names that where you can maybe make a quick earning real fast, because those other earnings, they can go down for you very quickly and wind up not being a great investment. So we're looking for those solid areas that have actual true fundamentals to be able to report. And so I think as investors, there's times we just have to say, I acknowledge that where I'm holding has been, for whatever reason, its price value has gone down. But more importantly, you know, what do I think is going to be worth, you know, in the future? And so that's kind of where we, I think, are generally. What I do want to show is just looking at areas of relative strength, kind of what we're seeing. So commodities has really been on the top of domestic equities for quite some time now. Not surprising when you look at the run-up that energy has had. So energy is up 60% year to date. You know, you look at what oil has done alone, that's not super surprising. We've seen that also a lot of commodities, so you know, a lot of those commodities, no matter what, even in times of inflation, those are things that are needed to keep the country running. I mean, even things like, you know, farmers need fertilizer, and so those types of things are always going to be a need, and we still need fuel to be able to transport. And so commodities has done very well, and then domestic equities remains in the second spot. And again, so there's been a shift a little bit there to value, not really surprising, versus growth. Value tends to be like those names, the staple names, versus tech funds and growth funds. So there has been a switch over there to value, as well as basic materials, consumer non-cyclicals, again, those kind of like consumer staples, and then financials is in the top 3 spot, just looking at sectors. And so again, After this sell-off, still encouraging to see that domestic equities is in the number 2 spot, just under commodities. So again, we're still kind of not seeing these like flashing signs that, you know, this is the financial apocalypse again. This is really just, there were a lot of areas that were overvalued, and now they are significantly undervalued, at least for the short term. And so just wanted to kind of show you where we're sitting with that. And then finally, my contact information. I know it can be a really concerning time, especially if you've been checking your accounts and you feel like, oh my goodness, at this point prices really can only go lower. And it's really important that we really try to invest not with our emotions, but kind of with what we know in our brain. I was kind of alluding to that we want to make sure that we're kind of making not emotional decisions based upon what's happening right this moment, but being able to kind of take everything into account, and most importantly, making sure that we are appropriately allocated for our risk. And so, as I said in my blog last month, if this has been really painful for you, really uncomfortable, you're having trouble sleeping, this is just like the worst thing, then you've probably taken on more risk in your portfolio than maybe your investor type would have allowed. So could be a good opportunity for you to take it to a fiduciary to take a look at your allocations and see if there's any recommendations that they might make. Again, you can always give us a call. We're always happy to speak with you. We're always happy to help any way that we can. We're always happy to give a second opinion. So otherwise, you know, we'll be back. And one thing I did want to mention, I'm super excited. We're going to be coming out very shortly with a summer series called Summer School. And so we have a whole list of professionals that are going to be coming in and sharing some very specific topics that we've identified that we believe that will be really beneficial for our clients and our followers. We'll be talking to real estate experts, mortgage rate experts. We're going to be talking to some CPAs. We will be also talking to some estate planning attorneys to really kind of help us holistically take a look at our financial portfolios and make sure that we're making the best decisions for the times that we're in. So look forward to that. We'll be getting some more information out about that. Otherwise, you can always give us a call. Thanks for joining us today, and we'll see you soon.